So once again, we continue to talk about U.S. China trade. That has been ongoing for more than a year, but it is encouraging. The most recent news out of both sides is they're working towards a phase one deal, which will address two out of the three big issues, if you will. The first being rebalancing the current account, so China buying more from the U.S., and the second is some kind of work around intellectual property protection and access to the domestic market in China for foreign companies, especially U.S. companies. So the reason why both parties, we believe, have incentives to work towards this phase one and why we're cautiously optimistic is the economies are slowing down. So China continues to moderate from its double-digit economic growth in the 80s and 90s, but you're still seeing signs of this trade dispute showing up in certain pockets of the economy. In the U.S., which has been very strong until now, you are seeing signs of more mixed data. So economically, this is definitely having an impact. And of course, the rest of the world, like the Eurozone, is feeling the impact as well. Within the U.S. specifically, the farming sector has been particularly impacted. We've seen the number of bankruptcies increase year over year, still small, about 600 out of 2 million farmers, but it is an increase of more than 20% year over year. And according to Farm Bureau, 40% of the farm's profits so far have come from the subsidies that the government have been providing. So again, not ideal. Farming is very important to the U.S. economy and also a very important base for the president. Most recently, I think another sign that's very encouraging, China came out and they announced they're going to be increasing the penalties for anyone that's actually going to be violating intellectual property protection. So again, signs are very encouraging that both sides are working towards this phase one deal. The second key issue that we've been really focused on this year is what central banks are doing. And as we mentioned previously, the Federal Reserve leading the way, they really shifted their stance from being very hawkish at the end of 2018, looking at potentially hiking rates, to now having cut rates several times. And you've got the ECB and the Bank of Japan, so what we call the big three central banks in the world, they've continued to be very accommodative, so providing a lot of liquidity. Interest rates are very low around the world. So what this has meant is it's provided emerging market central banks with a lot of flexibility, and they have been taking advantage of it. They've been cutting interest rates, but more importantly, in our view, several emerging market countries have actually been stimulating fiscally. So you've probably been reading about how we're hoping or waiting for fiscal stimulus out of Germany, for example, or the Eurozone. And what fiscal means is when the government spends more on the economy. It could be on infrastructure, it could be tax cuts, etc. And that's more stimulative than potentially what central banks are doing. So in emerging markets, because the debt levels for these governments are lower, they're younger countries, we have seen that. So India, for example, just recently cut their corporate tax rate across the board to 10%. That's a significant savings for corporations, which we do believe over time will be reinvested into more jobs and perhaps more capital spending. We've also seen Korea announce what they call a supplemental budget, so an incremental government budget to stimulate the economy. Russia announced a pretty significant infrastructure plan. So these are all indications that this is the importance of emerging market countries where they do have the ability to stimulate when it's necessary, and they're doing so. So there are a lot of factors that we're still watching when it comes to emerging markets, but certainly at this moment we believe a lot of the risks related to trade, potentially related to geopolitics, depending on the region, we believe it's more than priced in. So at the present time, we're actually strategically overweight emerging markets across our portfolios. And our view is not that everything's rosy and that everything's been fixed or there are no problems. It is rather that we believe these assets, especially on the equity side, has more than priced in that risk. We also are slightly overweight emerging market fixed income or emerging market bonds. Again, just an attractive opportunity to earn yield, and we're funding that through a slight underweight in U.S. high yield, where we do believe that, especially in the energy sector, there is a higher risk of default should the economy continue to moderate or slow down. So our preference in terms of higher yielding opportunities in the emerging market fixed income. So overall, not clean to clear yet, but we believe a lot of the risks have been priced in, so strategically overweight.